Hello, children. Today we are going to solve the third problem with respect to incidence of tax. This problem has appeared in the year November 2018, 2021 in a section C, which carries around 12 marks. First, I'll read the problem, we'll understand the problem. Later on, we will solve it. Okay, Sri Ram submits the following particulars of his income for the previous year 23-24. First one, income from the house property in Assen received in Paris. Basically, income generated where? From the house property, it is generated in Assen. Assen, where it is situated in India. So anything Indian income, it defines as earned, received, accrued, raised. Any one happens in India, that we treat as an Indian income. So what I do, I'll mention this income as an Indian income. Okay, next. Salary from income from an Indian employer received in New York for 2 months, rupees 75,000 per month. Again, here, the income salary from an Indian employer received in New York for 2 months in 75,000 per month. See, salary, the base of a work is in India, but received is in New York. Whatever may be, is earning where? In India. So this again we treat it as an Indian income. So it states as a earned in India. Okay, income from a business in Mumbai received in Bangalore. 40% remitted to Nepal. Whatever the remitted part we are not going to see, where the business is carried on, it is carried on in Mumbai, and where the amount is received in Bangalore. So the everything earned is happened in India and received also in India. So this we treat as an Indian income. If it is Indian income, it is taxable in all the three cases. That I need not say. In the previous problem we have seen, it is taxable in the case of resident and ordinary resident, resident but not ordinary resident and non-resident. Next we go, children. Dividend from a foreign company received in Chennai, rupees 1,80,000. So any dividend which is received in India. See, it's a dividend from a foreign company received in Chennai. Where we have received in Chennai. Where is Chennai? Chennai is situated in India, so we treat that as an Indian income. So again, it's taxable in all three cases. Income from a business in Hong Kong and business controlled from Tumkur. See, there is a business in Hong Kong. Hong Kong, basically, it's a foreign income. So the business controlled, where it is controlled, the head office is situated in Tumkur. Where is Tumkur? Tumkur is in India. So here, two things are there, where it says a foreign income as well as where it says a controlled income as well as an Indian income. How Indian income? Because 25% of the amount is received in Tumkur. So first I will say it as a controlled income. Head office is controlled from India. And the second, if it is a controlled income, it is taxable in two cases. That is resident and ordinary resident, resident but not ordinary resident. Non-resident, we are not going to touch. Whereas Indian income, it is taxable in all the three cases. So both the income will come, controlled income as well as Indian income. How Indian income? 25% of 15 lakh is received in India. Okay, that we treat as an Indian income. The rest, the balance amount, we treat as a controlled income. Okay, we go to the next one, children. Interest in post office saving bank account in Bangalore, rupees 14,500. See, one thing we note that if it is excess of 7,000 is taxable in case of interest of saving bank account. So here the interest what in the post office we have received around 14,500. So according to the IT Act, it says up to 7,000 it is exempted. So what we need to do is 14,500 minus 7,000. It comes around 7,000 is taxable in all the three cases, and we treat that as an Indian income. Okay, children, we go to the next one. Income from agricultural land in Sri Lanka, 50% received in India, rupees 2 lakh. See, agricultural income is generated in Sri Lanka. Sri Lanka basically we treat as a foreign income. So out of that 50% received in India. So both two things will come. One we say as a foreign income. Foreign income. Why? Because the agricultural income is situated in Sri Lanka. Sri Lanka is out from India. So basically 50% is received in India. That means 2,05,000 into 50 by 100. The balance 50% we treat it as an Indian income. So both are there in this transaction. Okay. So share of an Hindu undivided family, it is exempted income. Any share received from an Hindu undivided family, it is an exempted income. So if it is an exempted income, we'd say it as a tax-free income. So zero in all the three cases. If it is a foreign income, taxable in only one case, that is resident and ordinary resident. Royalty received in India for the service rendered in Japan, 6 lakh. Royalty received, any income which is received in India, we treat that as an Indian income, so taxable in all the three cases. Interest earned on USA government bonds received in London, rupees 1,75,000. So interest earned on USA government bonds. So investment made in USA and the interest is generated in USA, but received in London, 1,75,000. There means nothing is received in India. So generated earned in foreign and received also in foreign. So basically what we treat this as a foreign income. This is taxable in only one case, that is resident and ordinarily resident. Next, interest on SBI deposit received in Bhutan, rupees 7,080. Interest on SBI deposit received in Bhutan. So this basically, we treat that as an Indian income. Indian income. Why? Because see, interest on SBI, Saving Bank of India, deposited. It is deposited in India, that is in SBI related to India, but received in Bhutan, wherever it received, but deposited in India. So I treat that as an Indian income. So it is taxable in all the three cases. Next one, past untaxed foreign income brought to India during previous year. This is exempted income. Whatever the foreign untaxed income which is brought to India during the previous year, it is not taxable. Interest on housing loan given to Mr. X for construction house in Bangladesh, received in Bangalore. See, amount we are receiving in Bangalore, whenever any amount which is received in Bangalore, we treat that as an Indian income. So it is taxable in all the three cases. So, okay, children, now what we do, we go for the solution. As I told, we go by the format. The format says computation of total income, where the assessee, just I'll see the name of an assessee here, Sriram. Assessee is Sriram. So what I do, I just mention in the assessee column as Sriram. Sriram, okay. Sriram is an assessee. And on the right hand side, I'm going to write the previous year 2023-24, assessment year 24-25. So I have this column, serial number, where I'm going to mention the numbers, type of an income, the particulars what we are going to mention, nature of an income. Nature of an income may be either an Indian income, exempted income, foreign income, controlled income. Next, resident ROR, RNOR, NR. ROR means resident and ordinarily resident. RNOR resident but not ordinarily resident. NR is non-resident. First, I'll read. We will come from the beginning and just we will see which type of an income and how it is taxable. Income from house property in Hassan received in Paris, rupees 6,50,000. See, this I straightly say as an Indian income. Now we'll discuss how it is an Indian income. See, where is Hassan? Hassan is in Karnataka. Where is Karnataka? Karnataka is in India. So any income which is generated in India, we treat that as an Indian income. If I say Indian income, it covers earned in India, received in India, raised in India, accrued in India. So this is basically an earned in India. Okay. So I treat that as an Indian income. When it is an Indian income, it is taxable in all the three cases. 6,50,000 is taxable in all the three cases. Next, salary income from Indian employer received in New York for 2 months, rupees 75,000 per month. See, salary is the employee is worked in India. He has received a salary in India, but received in New York for 2 months. He is an employee of Indian employee. Okay. So here he is receiving a salary where he is working in New York for the period of 2 months, 75,000 per month. See, basically, it is this is we treat as an Indian income. Why Indian income? Because it is earned in India. Okay, it is earned in India. So 75,000 into 2, it comes to around 1,50,000. So I mentioned 1,50,000. If it is Indian income, it is taxable in all the three cases. Okay. Income from a business in Mumbai received in Bangalore. See, Mumbai is in India, Bangalore is in India, but 40% remitted to Nepal. Here, earned in India, received also in India. So I do treat that as an Indian income, and directly I will mention it as a 12,50,000. That is taxable in all three cases. So what I do, I just copy it and put it to the cell. So 40% remitted here, we are not going to consider, since earned also is there, earned in Mumbai, received in Mumbai, both are inside India. So I treat that as an Indian income. Understood, children? Next, we are going here. Next, we are going dividend from a foreign company received in Chennai. See, foreign company, I got a dividend from a foreign company apart from India, but received, the amount is received in Chennai. See, whatever Indian income it states that earned, received, raised, or accrued. So here we are seeing received in India. So I treat that as an Indian income, and it's taxable in all the three cases. 1,80,000. 80,000, okay. 1,80,000 taxable. Next, income from a business in Hong Kong and business controlled from Tumkuru. 25% received in Tumkuru. See, we have a Mr. Sriram is having a business in Hong Kong. Okay, that is a foreign income. But the business is controlled from Tumkur. That means they have an head office in Tumkur, where in India, that is controlling their business, which is situated in Hong Kong. So I say that as a controlled income. I say that as a controlled income. Controlled income. So one more income is there. See, out of that, they say 25% received in Tumkur, rupees 15 lakhs. If it is received in India, that we treat as an Indian income. Indian income. So first I will say 15 lakh into 25%. 15 lakh into 25%, it comes around 3,75,000. 3,75,000. 3,75,000, since it is an Indian income, it is taxable in all the three cases. Controlled income, 3,75,000 minus 15 lakh. So that comes around 11,25,000. 11,25,000. So that is taxable only in case of two. Resident and ordinary resident, resident but not ordinary resident. In the case of non-resident, it is not taxable. See, if I add this both, I should get around 15 lakh. Okay. Understood, children? Now we are going to the next one. Interest in post office saving bank account rupees in Bangalore. In Bangalore, rupees 14,500. See, according to the IT Act, it says any interest in post office, if it is excess of 7,000, that is chargeable to tax. So 14,500 minus, I'll mention it here itself. I'll state like this. 14,500 minus 7,000 minus 7,000. The balance is taxable. Balance comes to 7,500. 7,500, it's taxable. I treat this as an Indian income. Why Indian income? Because the interest where I have received in Bangalore. Bangalore, it is in Karnataka. Then Karnataka is in India. So I treat that as an Indian income. If it is in Indian income, 7,500 is taxable in all the three cases. We'll go to the next one, children. Income from agricultural land in Sri Lanka. Where Sri Lanka is situated? Foreign. Okay. But 50% they say received in India. So two types of income we have again. Agricultural land where it is in Sri Lanka. Sri Lanka is a foreign. So I treat that as a foreign income. And since the amount is received in India 50%, again we have Indian income. So this, I will say foreign income 50% received in India. First, I'll take it as a 50% received in India plus 2,05,000 divided by 2. Okay, 1,02,000, that is taxable in all the three cases. Okay, the balance 1,02,500 is taxable only in one case, that is foreign resident and ordinary resident. So what do I mention? The rest column, I'm going to mention it as 0, 0. Understood, children. Once again, I will explain here. Since the agricultural land is in Sri Lanka, it becomes a foreign income. Since 50% is received in India, that is an Indian income. In case of Indian income, 2,05,000 divided by 2, we have got 1,02,500 that is taxable in all the three cases, whereas foreign income is taxable only in the case of resident and ordinarily resident. Next we go, children. Share from Hindu undivided family is rupees 60,000. As we know, Hindu undivided family, any share or profit that is exempted income. So if it is exempted income, I say that as a tax free. So here, if I write a tax free, the total will not come. So what I do, I will put it as 000. Okay. Next, royalty received in India for the service rendered in Japan, 6 lakh. Royalty received in India for the service rendered in Japan. Royalty received. See, any royalty which is received in India, wherever the service does, we treat that as an Indian income. Why Indian income? Because it has satisfied out of the four category that is earned, received, accrued, raised. So any one received in India or earned in India or accrued in India or raised in India. If it satisfies any one condition, we treat that as an Indian income, and it is, if it is Indian income, it is taxable in all the three cases. All the three cases. So one more zero I should add for 6 lakh. Okay, 6 lakh. All the three cases. Okay, done. Next, interest earned on USA government bond received in London. See, both here, interest on USA, they have taken, Sriram has taken USA government bond that is in foreign and the amount received in London. So both are in foreign, whether the bond is belongs to USA government bond, that the amount they have received in London, both are foreign. So since nothing is received in India, I do consider that as a foreign income. If it is a foreign income, that is taxable only in one case. That is resident and ordinary resident. Rest both the case is not taxable. Next one. Interest on State Bank of India deposited received in Bhutan. See, interest in SBI. Okay. State Bank of India, they have deposited certain amount in India, but received in Bhutan. See, whatever we have in earned or that is an Indian income in India, that we treat as an Indian income. If it is an Indian income, it is taxable in all three cases. Okay. Next, past untaxed income brought to India, 6,10,000. Any untaxed foreign income which is brought to India during the previous year, it is exempted. Nothing is taxable. It is a tax-free in all the three cases, but instead of that, I cannot write as a tax-free, so I'll mention it as a zero. Last one. Interest on housing loan given to Mr. X for construction of house in Bangladesh received in Bengaluru, 65,020. See here, wherever the housing loan given to the X construction in Bangladesh, but the amount where it is received, the amount received in Bangalore. Where is Bangalore? In Karnataka. Where is Karnataka? India. So if it is in India, anything we have received, that we treat as an Indian income. And if it is an Indian income, it is taxable in all the three cases. 65020. So what I do, I just copy it down 65020 in both the columns. Here, I think the font is changed. I'll reduce the font. Go here. I'll make it 14. Okay, now it is correct. So fine. I hope so, children. We have finished the problem. Here, the gross total income is 47,89,600. Then 45,12,100 in case of resident and no, but not ordinary resident. In case of non-resident, we have 33,87,100. I hope so, children. You have understood this problem. In case if you have any doubt related with this problem, just mention in the comment section so that I can get back to you. Thank you, children. Thanks a lot.